Hi, I'm Max Keiser. This is the Keiser Report. You know, numbers can tell different stories. Don't get fooled by the hype. Stacey Herbert, tell us more.
Yes, Max, in the past week we've had a Dow Jones hitting all-time highs, and everybody, of course, celebrating that the jobs numbers look good. They came in better than expected. But check out this headline, and yet the labor force participation rate is still falling. And turn to this nice chart here, and you can see that, yes, indeed, this is the participation rate by those available to work in the market, and they are not working. 63.5% of the workforce is actually working now. Of this, looking at the chart and the data that was available from the Bureau of Labor Statistics, is that Felix Salmon of Reuters said that the number of multiple job holders rose by 340,000 this month to 7.26 million, a rise larger than the headline rise in payrolls, which means that one way of looking at this report is to say that all of the new jobs created were second or third jobs going to people who were already employed elsewhere. So remember, this is that famous scene looking back on George W. Bush when he was campaigning for re-election, and he was sitting there with that woman who said, "Yeah, I have 3 jobs," and he's like, "Uniquely American, isn't it?"
So these are people who are taking on second and third jobs, and these new second and third job holders, that's calculated as being a new job overall, and this is heralded as, oh, this is fantastic, there's growth in the economy, but the labor participation rate continues to decline. But that faulty assessment of what's happening with jobs is all the impetus needed by the algorithms on Wall Street to kick in, borrow another trillion or 2 trillion, buy stocks at the market, drive the Dow Jones to new highs, and then say, you see, jobs are plentiful, stocks are higher, failing to say that the job participation rate's crashing and the debt driving these prices has never been higher. So there's this huge gulf between the statistical representation of reality and what the being experienced on the ground, on the street, by the average Joe and Josephine bag of donuts.
You know, I've seen headlines in New York Times alleging that these jobs numbers prove that Ben Bernanke's quantitative easing, the quantitative easing to infinity, is working, and that we can continue that because these jobs numbers are so good. But as you see, again, you know, the participation rate is down, and those who are working are having to work 2 or 3 jobs to keep up with inflation.
Yeah, let me jump in here for a second, because over in the United Kingdom, of course, people are saying, look at America, their stimulus is working, George Osborne, and you know, we need to go away from austerity in the UK and bring about American-style stimulus. Does that mean the people in the UK want second and third jobs on top of the, you know, their current work environment that they're complaining about, that they can't seem to get through the day as it is?
Looking forward, this is sort of a bad omen as well for what will happen under Obamacare, because one of the interpretations of this is that Obamacare means that the employer has to provide health insurance to their employees if they have over 50 employees. But if they're working full-time, and full-time they count as 30 hours. So apparently a lot of corporations are cutting job hours work to under 30, so people are having to find a second job to fill in the hours they need.
Well, instead of Obamacare, Barack Obama should have created something called the Individual American Well-Being Account. And 1% of every securities offering, every stock, every bond, every derivative, every securities offering, the trillions of securities that are offered and packaged and sold in America, 1% would go into the American Well-Being Fund. Wall Street would never notice the difference. Bonuses on Wall Street would be impacted by very little, and all that money would accrue to the people who are actually building the country, and not the frickin' charlatans and thieves who are raping the country. Barack, put your thinking cap on, you dunce!
So the other big headline news of the past week that everybody in New York City, Manhattan here behind us, are shouting with glee, running around, buying $7,000 bottles of champagne, popping them open, smashing them against a wall. They don't care about money. Apathy over the Dow's rise is unsurprising. Yes, apparently outside of Manhattan, Max, people don't care so much about the Dow Jones hitting an all-time high, because Christopher Caldwell of the FT says what looks like a rally may just be the effect of elites passing money among themselves.
You go back to the banking collapse of 2008. We found out that banks like Lehman Brothers, Bear Stearns, JP Morgan, and Goldman Sachs would, at the end of each quarter, exchange debts to fool fool the regulators into thinking that they had less on their balance sheet. And then when they booked the debts again after the regulators left, they would book that as a capital gain. So they were just playing this Ponzi scheme of capital gains, and they've extended that now to a multi-$100 trillion derivatives market. The biggest banks in the world are in this huge circle jerk or daisy chain to award themselves illusory profits and then pay themselves huge bonuses tied to options and warrants on their stock price that go up based on essentially what, at the end of the day, amounts to financial masturbation.
I mean, the other thing is that, as they point out here, in the half-decade since the Western financial system almost collapsed, the relationship between stock markets and the real economy has seemed more tenuous. You could describe this in many, many, many ways. One of them we've described as neo-feudalism, that they just don't need the population. They don't need most of the population in a financialized world, and they could just extract equity and rent from everybody around the world.
Well, it's a mistake to point to the disconnect between the economy and the stock market as being indicative of there being some underlying financial skullduggery, because the economy and the stock market rarely go hand in hand. Occasionally they will coincidentally march together, but that's not generally the average between these two indexes. But what we can say is that the wealth is being ported over to the big house of the slave masters, and that the people who are not engaging in this stock market rally, it's not because there's a disconnect with the overall economy, it's because they're being disenfranchised and enslaved. We're back to pre-Civil War days. The antebellum South will rise again in America. You got slaves all over America working for Uncle Tom, that is J.P. Morgan's Jamie Dimon, who let them in the big house every once in a while and throw them a bone. But other than that, go out there and pick cotton. Y'all know good, Nick, because I'm Jamie Dimon and I run this plantation. Yeehaw!
Well, of course, one of the famous sayings about Wall Street is, where are the clients' yachts? Of course, clients don't have yachts. The bankers are the ones that have yachts. And this, of course, is alluded to in this FT article, where they say the U.S. Federal Reserve has added more than $2 trillion to its balance sheet since 2007. In general, the tide of liquidity ought to lift all boats in the harbor, but when the harbor is an equity market, you won't find your yacht lifted unless you own one.
Yeah, the Occupy Wall Street, they should all go to Greenwich Country Club and the Greenwich Yacht Club and occupy the Greenwich Yacht Club. That's where you need to go and occupy and sink all those frickin' boats. Sink 20,000 yachts in Greenwich, Connecticut. Send a message.
But Max, those bankers already have credit default swaps on those yachts, of course, so they'll make a fortune if you sink it.
Of course, they've got all those yachts collateralized in credit default yacht default swaps.
So now we've looked at the true story behind those good headline jobs numbers and the true story behind the so-called bouncing, booming Dow Jones. Now let's look at the maestro and what he says about these sequesters, you know, the $85 billion in cuts. Well, Alan Greenspan, the former Fed chairman, was asked about these cuts and whether or not they would do anything. Greenspan, sequester cuts won't be horrendous for economy. He says the crucial issue is how the sequester influences the stock market, because the stock market is the really key player in the game of economic growth at the moment, he says. The data show that the stock prices are not only a leading indicator of economic activity, they are a major cause of it.
Well, Greenspan's pacemaker is connected to the Dow Jones.
Yeah.
So unless the Dow Jones keeps going up, Greenspan's going to keel over and die.
It's an important thing to realize that this is his thinking. He says that prices cause activity, cause economic activity, and that the reason is the wealth effect of the stock market, he says, which has risen to 5-year highs. And it explains why the consumer has been able to overcome various headwinds, such as the payroll tax increase. So the price rises are illusory. They're not real. They're fake. They can evaporate. We've seen that happen. The tax increases are real. They take your real wealth, your real savings, your real money, and transfer it to basically Wall Street.
Well, I mean, a great example of that would be a company like Corrections Corps of America, the biggest, largest prison operator in America. The stock price goes up. According to Greenspan, that's great. The fact that they've cut deal with municipalities around the world to put 98% occupancy rate in their jails, and you rounding up people and prosecuting them and jailing them to satisfy the needs of that stock price never crosses the mind of Greenspan. So again, it's a good point. The price, he's saying, is the be and end all. That what that price represents never enters his brain.
And then finally, Max, on the story of Alan Greenspan and saying that stock prices are determinants of everything, every record Dow Jones point costs $200 million in federal debt. We're hitting all-time highs in the Dow Jones, but there's no such thing, of course, as a free lunch. Where does it come from? Here is the invoice. In the past 5 days alone, total federal debt rose from $16.64 trillion to $16.7 trillion, an increase of $61 billion in 5 days, amounting to $198,697,068 for every of the 307 Dow Jones Industrial Average points gained this week. Because remember, U.S. debt is the asset that allows the Fed to engage in monetization and, as a result, hand over trillions in fungible reserves to banks.
Yeah, well, they're saying that the accumulation of debt, $200 million of debt for every Dow Jones point, is meaningless. And the only way they can possibly say that is if the Federal Reserve Bank in Washington, D.C. will never have to unwind the debts that they've taken on to make this bubble occur. And the only way that's going to happen is if you've got a global recalibration of the major G7 currencies. And the only way that's going to happen is if the dollar takes a 50 to 60% hit against these other currencies, which is exactly what the gold market's telling us. Let me put this into perspective why I'm not that impressed with Dow Jones at 14,000. Because I've owned gold now during this rally. For the Dow Jones to equate my performance in gold, it would have to be at 40,000, not 14,000. You see what I'm saying? Against gold, it's been a complete loser. It's been a disaster. Against Bitcoin, it's hit a 90% all-time low. So it's a big round trip to nowhere. How much money did it take to keep the Dow Jones from going absolutely nowhere over the last 12 years? 1 trillion? No. 3 trillion, as Ben Bernanke's had to assume on the Fed's balance sheet? No. The contingent liabilities mean the Fed and the U.S. government had to take on 30 trillion in new debt to go absolutely nowhere. All right, Stacey Hibbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away, much more coming away. Stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Steve Keen, author of Debunking Economics. Steve's also got a project on Kickstarter. He's raising money for a dynamic financial simulation called Minsky. Steve Keen, welcome back to the Keiser Report.
Glad to be here, mate.
Steve.